taking credit scores from CIBIL, Experience, Swift might not give us the right underwriting, even the model, or even think about it, because these customers who are actually going in for microfinance or small digital, they don't have a digital footprint. Now that's where the fintech part sort of comes in, where we generally, what we try to do is get as many data points as possible to have a holistic view. It could be the electricity bill of the person actually residing in a certain place. You could actually digitally get that. Shopping information, SMS tracking information, GST, even the bank statements and how the money is going in and out. Access to his POS, if he has a small POS app, is there a way to sort of get that? So, and that's where AI and ML comes in to overall build a holistic score to say, okay, he might have a lesser amount of digital footprint, right? But is he a person that I can rely on, and would he be someone who can, and how is his digital habits of repaying and things like that? So I think that's where the power of digital lending sort of comes in, and that's what you sort of covered, Pranay, also. But nothing more to add on that one.
Yeah,
thanks, Ajit. Yeah, please.
Yeah. So yeah, I know that everyone love these topics, and they already touched a lot of good points. I will basically, so I think when you analyze the risk of a customer, right? So obviously all this data point that we talked about, that Manish was talking about, getting the holistic data points, and what Kamal and Pandit talking about using the AI and ML algorithm to use this data to create the right model to understand the customer's risk. So one of the element that I personally feel is that which is about that, if you see that microfinance, right? Today on the ground, there are a lot of microfinance are operating around, right? And what I always see that the greed of the financier lenders, right? So there's what's happening is that on the ground, maybe at the same time, the same customer has been approached by the different microfinance, and they're part of the different groups, right? Maybe at that point, all the data, if one microfinance analyze it, maybe even the AI model that maybe predict that he maybe qualify for some sort of the loan, right? But at the customer level, if he's getting the couple of loans at the same time, that's something that I fear about it, right? So something that exposure, that how much the customers are getting around, right? Because at the end, as a company can evaluate your own exposure, right? With what are the data that we have, right? At the same time, if they are able to get the loan from other, then the overall exposures are going to increase, and that is something. Is of course the good thing on the digital. So the data and everything are getting real time, but still they're required that how can we have a lot more better checks on the real time, right? Like even the bureau and all data, generally you all have experience that has the lag of data of 1 month and 2 months, right? Someone is quarter also, right? And that is the element there where a lot of things are happening. And what Manoj are talking about, how the people started gaming, right? So in the Kenyan, so India markets everywhere, whether this is the financing world, there is the people we figure it out, right? And the like middle layer people who generally they start creating those types of loopholes, and they start using it. So somehow we have to figure it out, and because that's very important in analyzing the credit risk of a customer, right? So because that what is the overall utilization that I should have, right? What is the loan exposure that I should have given to that, right? Yeah, Panne.
Thanks, Ajit. So in interest of time, I would like to jump to the lessons that we have for the future. So for this concluding session, I would like to take the reverse sequence. We'll start with Ajit, then Manish, then Kamal, and then Manoj, so that we have the opportunity to properly listen to everybody. So in this, I'm posing a question to each one of you from the perspective of the audience. So if there is one key thing that, as somebody who is wanting to enter digital lending, or who is already into lending and is wanting to learn one key lesson from each one of you, what would that key lesson would be for the future? So how would you like to advise me as somebody who is wanting to learn? Yeah.
So so I think one of the key element, and I think the good has that a lot of fintech players have been doing that, right? So one of the key thing is still that struggling the type of population that we deal with, like a microfinance or the people like us who may be talking about the LMI segment, the low medium income segment, is more about how you can capture the data more in digital format. Right? So that is something that is still the, I know that the bank statement, other things are coming around. That's a really good thing that happening, right? But that's when I was talking about this whole holistic data capture, right? How can we have more better way to basically figure it out? Okay, some of the data point that we're talking about, like as Kamal was talking about, that if you have different economic indicators, right? How can we get that those economic indicator more in the digital formats, right? And always authentication of those data is also the bigger challenge, right? So if those things are work around, right, because that is something a gold mine, because I know that as Pranay talked about, we have a good understanding of how the AI and ML thing can work, right? If we have the right data set up right with authentication, I think we can have even more better niche way to identify the right set of people who has good intent and ability to pay the loan. Yeah. So yeah, that's the way I will say that fintech players start thinking more, right? I know that a lot of works are happening, right?
Sure, Manish.
Yeah, so if I have to again step back a little bit and
Your own sweet time. So we know that we have not heard from you much. Please take your own sweet time.
yeah. No, I think thanks for that. So one thing that if I had to holistically look at any lending, it's about making sure that the aspirations of a customer, it could be microfinance, it could be MSME, it could be personal loans. Aspirations of a customer, his needs has been met, and the entire cycle is of obviously managing that loan EMI and then obviously collection. Now, generally, what happens is different fintech companies uh, focus and their strengths lie in certain areas. Some could be origination, some could be loan management, some could be collection. Now, and the underwriting actually comes in the origination bit. But I feel that companies that look at it holistically and have a closed loop feedback model from collections to here is the decisions that we've done, here is the amount of underwriting we have to sort of let go, here are the different buckets of customers that are performed well, here are the segments of different industries that performed well, here are the different there are so many slicing and dicing, and it doesn't end at every step, like you were talking about origination, LMS, the underwriting part, and then the collection. It is the end-to-end view of the entire cycle, which makes any system stand out. While it's very difficult, but I think that is one of, if I had to say that if there's one thing that would that I would recommend companies to focus on, is this end-to-end value proposition versus one deep tech. So that would that's what I wanted to add.
Great, that's a good idea. Yeah, Kamal.
Yeah, so based on my experience, we are operating in a country where every 500 kilometers the law changes, customer behavior changes. So while defining this system or the processes, I think we should create a hybrid. We should have a hybrid approach. That if the prospective lender, let's say, wants to disburse something in Odisha, that would be a heavy touch model, right? But if we want to do in Delhi NCR, maybe a high tech model. So the technology basically should empower. The technology should empower the touch, because we are a lending institution, we are not an IT company. So without compromising with the lending process, keeping the geographical flavors in mind, we should define our end-to-end digital solution. Reason being, if some fintech company may have origination system, some may are very good in underwriting, some may are in collections. And if they are offering solution to the various partners, then probably the cost of technology will go up for the partner. So whether the solution, technology solution, is resolving the unresolved, that is the question which we should ask before developing that technology. So these things, geographical stuff, the ask which the lender is required, and a bit of variants of lending, like which can come across in future, should also be kept in mind. For example, if tomorrow you want to do a invoice-based financing, you have no choice but to go either a large technology company, maybe TCS or maybe Nucleus Software, or you have to take some other system. So that should not become hindrance in the product expansion and the growth.
Sure.
So that's from myself.
Yeah. Thank you. Yeah, Manoj, one key thing that you would like the audience to learn.
Yeah, so I mean, if you look at microfinance, I think the key thing about microfinance has been the simplicity. If you look at the product and the processes, really very simple. It's easy to train people. It is very easy to tell the client what we are selling, what are we in the market for. So it's a whole simplicity of product, and really the product and processes at the front end haven't changed that much. It's the same thing that is, so the client consistently knows how do we interact with this particular platform? What do we get out of this, and as in terms of a value proposition? Yeah. So nobody makes change isn't very well appreciated. So at the back end, a lot of changes have happened. There's been a lot of digitization, processes have changed, but at the front end, there is a certain amount of consistency that the sector has maintained, and I think we should appreciate the sector for that, because the client gets a consistency of sort of interface, which to Manish's point, really, Manish, we keep harping on this, that you be more client centric. But you look at microfinance, it's all about, this is my methodology. You will get the loan in this fashion. It's not a very client centric methodology. It's not a good thing. I'm not saying that fintech should even think about doing it. But what they should take away from while maintaining the client centricity that Manish aptly talked about is that there has to be a simplicity to it. Don't go overboard with your knowledge, with your ability to interpret products and do analysis to make the front end complex. Yeah? Don't do that. So.
Okay, that's great, and I think we have ended with a very deep point, deep insight, and good takeaways. I thank you, each one of you, for the inputs. And since we have jumped 2 minutes, I would now like to go over to the Q&A from the participants. I would need some help from Swaroop.
Hi, Pranay. So you can see the questions in the Q&A chat. So maybe you can pick it from there with questions which are relevant.
Okay, thank you. Okay, so here's a question which is quite relevant, and it aligns with the discussion that we have had. So the question which has come is, how long before we can have most collections happening digitally and probably, hopefully, automated? Since we did not touch upon the collection part, I think with this question we can hear from each, any one of you who would like to take this question. So, how long before we can have most collections happen digitally? Yeah.
I can.
Yeah, please go ahead. Go ahead. No, Manish, please go ahead. Oh, you go ahead, Manish.
No, because it was sort of a digital thing. So I don't know how long, but I think most of the collection already happens digitally, right? And obviously, we know that different buckets from 1 to 30, 30 to 60, 60 to 90, and then how the rate of flow between buckets are. What are the things that you need to do to make sure that the flow doesn't happen from one bucket to the other? Because as it flows from one bucket to the other, what really happens is your ability to get that loan back becomes smaller and smaller, right? The probability becomes smaller. So how do you upfront reach out to these customers digitally, send them payment links? But having said all of that, there will be cases where you just have to show up at someone's doorstep. I don't think so. We figured out a way to get around that yet, but I just wanted to add that.
I just want to add one point here. is that I think so. I think that still on the microfinance, the whole the cash collections are there, right? But I think till we solve the problem of digitalization of the money of source of income to the customers, very difficult to solve that like collection of the collection. So I think though the good works are happening, but the most important thing that we have to see that how we have ensured that the source or what is the way that people get the money, it should come convert in the digital format. I think if once that is done, automatically collection will start flowing around that.
I would just say that, I mean, if you look at a microfinance institution that was giving loan to two clients, one was a group lending, which is cash based, and the other was individual lending or micro enterprise lending, where people could pay through eNash and so on. I mean, during the demonetization, the micro enterprise, the eNash based or check based lending recovery rates were 50% thereabout, in an institution where group lending had got down to zero. So I think a clear message has gone to the microfinance sector that we'll have to do something about the whole repayment rate. It cannot just continue to be collection in cash. That said, the challenge, as Ajit pointed out, has been that this whole conversion of cash to digital costs money. Digital to cash and cash to digital is a friction point in our systems, and it costs money to convert. Till that arbitrage is available, and you know, if you go to a BC agent, they will say we'll charge 2% or 1.5% to do your collections. That doesn't work for microfinance. Microfinance is a very efficient methodology. It's a very efficient machine that drives it. The overall collection operations cost may be in the range of 4 to 5%. Yeah. If somebody says I'll just collect and charge 2%, doesn't work. So what we will see over a period of time is people at least now trying to do things. So like, for example, I was talking to one MFI and they said, we are trying to see that a group of 20 women, at least 2 or 3 take a phone. They then take money from others, digitize it, that is deposited into their bank account and transfer it into our bank account. Obviously, this woman will then start charging some money. She will become a quasi-agent without RBI ever recognizing her as an agent. But the fact that there is a service that is needed, which is conversion of cash to digital and digital to cash, these things are now bound to happen. MFIs will be forced to look at digital collections more and more, and you will see that the whole scenario would change in the next 2 to 3 years.
Sure. Thank you. I would pick up one more question, which which would apply to larger set of audience. Kamal, maybe you can answer this. What is top key challenges that MFIs are facing to transform into digital?
So the first thing is that the infrastructure availability in certain geographies, like the banking facilities or maybe the customer literacy level to operate digitally, or maybe the availability of the smartphones like Odisha, Jharkhand and those areas. The second is the mindset of the management, how keen they are to digitize. That is the biggest roadblock in the digitization in my view. This is what I've experienced in last 20 years of career. Because unless and until the management has a clear vision how they want to digitize the processes, it is very difficult to implement. Now, by force, because of the high OPEX, dropping yields, and maybe next 2 years, the lending rate will be freezed to 18 to 19% by RBI in MFI segment. So we have no choice but to digitize. So that's another roadblock. So these two things, mindset and the geographical characteristics in our country, are the two roadblocks as of now. And the third is the cost of technology. Like at what cost we are getting. So nowadays there is a cloud-based, data warehouse hosting, which is cheaper. So that also helps us for that. And the another most important part is the data. One is the data availability. Second is the quality of data. Because unless and until qualitative data is available, it is very difficult for us to arrive at the right kind of decision with the right amount of risk. Because even in the current scenario, the biggest challenge is a lot of fake Aadhaar card and fake these voter ID cards are still coming in the segment.
Sure. I think that answers. Then there is a comment here. I would like to read it out, and there is a question. Say 80 to 90% of the loan applications are probably rejected. It seems like credit evaluation is in itself a method that excludes super majority of people. How can it be made more inclusive? So interesting question. Would anybody like to take it up, or we can move to the next question?
Let me answer this, because it depends what is the maturity level of that organization, at what stage they are in lending. So if it is a new experimental lending scorecard based, or maybe one or two key parameters like bureau score kept very high, those could be the reasons of 80 to 90%. Otherwise, I don't see that a sensible management team, will either give a open sourcing whatever is coming junk in the system, or maybe the systems are so poor that there is no control on the good quality cases, also those get rejected. So in my view, I think it's the maturity of the organization. I have never experienced that any organization so far which are operating have had that kind of very high rejection ratio. That business will never be viable.
Okay, thank you. Ajit, over to you. There's a question on P2P. So are there any ready-made, ready-to-use P2P softwares for Indian environment? If yes, what are the overheads on the P2P platform provider, legally, risk-wise, etc.? So there's a question from Selva.
So as of now, I think so most of the P2P platform, they have developed their own sort of overall proprietary, whatever the system that they have, right? From the loan origination, from the underwriting, from the matching from the borrowers and the lenders, correct? And the overall things, right? So that is pretty much that every lender's P2P platform has been done, right? Recently, like us also, we have been like also working around how to use this whole P2P as a SaaS sort of services, right? Where because there are many lot of localized money lenders are there, right? Which are there using their, how can they can use this as a platform, right? Because to use as a P2P lending, you have to get an NBFC license, right? So that is most important, right? So so there may be couple of the software company which were working around their own way to do it, but most of the people, they have developed their own proprietary way of from end to end, right? That is one thing. Coming to the legally and the risk side of the P2P side, as I told you, that is a regulated identity as, under the RBI, right? So someone who want to do this has to get first to get a license, right? What the license allowed us that we can just work as a platform. So basically, so we are here to connect the borrowers and lender through us, right? So all overall, so we at the end we are not building our book of our own, right? So it's only all the risk lie on the lender side, right? But given that since it's a platform and you want the lender to come to platform only for they're coming for return, it's very important as a platform to make sure that you are doing the right due diligence. You are making sure that the overall the risk of the platforms are make sure that are minimized so that the lender get the right return, right? So at the end, the whole idea of the whole platform is that we just work as a sort of service provider for both borrowers and lenders, right? And in that we basically generate the fees from both of them, right? But on the core, if you see that we pretty much do all the heavy lifting, right? From the borrower sourcing till the lender sourcing and making sure that collection and everything are done, right? So that it is a good way to both borrowers and the lender, right? So
thanks, Ajit.
Yeah.
So given we have left for 2 minutes, I would pick up two questions. Manish, one question for you. So given the risks of lending with no pledge assets, what is the current viable interest rate? I think you would be in a best position to answer that.
Well, I don't know if there's a right easy answer to this, right? It also depends on, at what rate your company is able to borrow money, right? One is, what is the company able to borrow? Second is how it's able to control its losses, when it comes to, ECL, which is, your estimated credit loss. And it's all of that, what does it take for you to run the business, which basically adds to, how much interest rate actually comes out. So it's a combination of that. And depending on which company at what stage and what maturity it is, you would actually find a different interest rate.
Sure, thanks. One last question that I'm going to have now. So there is a suggestion, why not disperse in stages to ensure proper utilization of earlier installments? Is anybody having any views? May apply to maybe Manoj from your Kenya experience. Do you think installment should be, we should ensure proper utilization of earlier installments before more disbursements are made?
Yeah, I mean, if you go up beyond a particular size and you are now getting into asset finance, that is when installments kick in. I mean, if you look at a typical banking sector, then installments kick in when you are into asset finance or you are doing project finance. That's when. But once you are talking in this, sub 5 lakh range, and typically giving money for working capital usage, I think that's where installments doesn't really work. But we should be mindful that this is working capital. It's never easy to get out of a working capital cycle of any borrower. So it is in some senses a perpetual loan that we are making. But yeah, that's where I would.
And the other one is there is an instant need to fulfill. That's why they take term loan. If that doesn't serve the purpose, then probably they may not borrow.
Yeah, very good point. Excellent. Yeah. So with this, I think we have, I would like to conclude the discussion. And I thank you, each one of you, great inputs. I myself had a lot to learn. And I really hope that the people who are listening to this webinar also are taking away some insights and learning from the whole discussion. Thank you so much. Over to you, Fro.
Thank you.
Swaroop, over to you.
Thanks, Pranay. And thanks for moderating, and thank you everyone for joining here and sharing the insights on the topic. If we have more questions, we'll receive it from the participants on email and we'll individually reach out to all of you. Thank you so much for your time, and thanks everyone for joining the webinar as well. Thank you.
Thanks.
Thanks.
Thanks, Pranay. Thanks, guys. Thank you so much.
Stay safe. Thanks. Bye.